Ever wondered why interest rates seem to be stuck in a perpetual limbo, refusing to budge no matter what economic twists and turns we face? Well, my friends, today we're diving deep into this financial enigma. So, grab your favorite beverage, get comfy, and let's embark on a journey to unravel the mystery behind why interest rates are not dropping. To understand the present, we must journey into the past. Greetings, everyone. I'm AIpreneur, and as you might be aware, I enjoy crafting content on personal finance, along with dissecting the various benefits concerning taxes and interest. Picture this: a world in economic turmoil, where the Great Recession had gripped us all in fear. Central banks worldwide slashed interest rates to historic lows to stimulate spending and kickstart the economy. It was like pouring fuel on a dying fire, hoping for a rekindling of prosperity. But what happened next was unexpected. As the economy began to recover, interest rates remained stubbornly low, like a guest who overstays their welcome at a party. Central banks, perplexed by this anomaly, scrambled for answers. Some economists argued that it was due to sluggish economic growth, while others pointed fingers at global factors beyond anyone's control. But the truth, my friends, lies in a tale as old as time itself: the delicate dance between supply and demand. Let me help you understand. What is the role of central banks? Have you ever wondered who holds the reins when it comes to interest rates? Well, let me introduce you to the unsung heroes of the financial world's central banks. These institutions, like the Federal Reserve, have a crucial job: to keep our economy in balance. But what exactly are they balancing? It's a delicate dance between inflation and unemployment. Let's break it down. Picture the Federal Reserve as the conductor of an economic orchestra. Their objective: to maintain price stability for keeping inflation in check and maximize employment. It's like walking on a tightrope. Too much inflation can erode our purchasing power, while too little can lead to economic stagnation and job losses. So, when you hear about the Federal Reserve adjusting interest rates, it's their way of fine-tuning the economy, ensuring that we're not overheating or stalling out. It's a tough job, but someone's got to do it. How does the Federal Reserve manage economic indicators and their impact? Now that we understand the role of central banks, let's dive into the nitty-gritty of how they make their decisions. It all boils down to economic indicators, those pesky numbers that economists love to analyze. But fear not, my friends, for we'll break it down in plain English. Think of economic indicators as the dashboard of our economy. We've got GDP, employment rates, consumer spending, the works. These numbers give central banks insight into the health of the economy. When GDP is booming, employment is high, and consumers are splurging, central banks may raise interest rates to prevent inflation from spiraling out of control. But here's where things get interesting: the bond market. It may not grab headlines like the stock market, but it holds immense power over interest rates. When investors flock to bonds, it drives down yields, signaling lower interest rates ahead. It's like the silent but powerful whisper behind the scenes. How does the Federal Reserve manage global influences? Now, let's zoom out and take a global perspective. Our economy isn't an island, it's interconnected with the rest of the world. So, what happens across the pond can ripple back to our shores, especially when it comes to interest rates. International trade plays a significant role in shaping domestic interest rates. When our trading partners thrive, it boosts demand for our goods and services, leading to economic growth and potentially higher interest rates. But if they hit a rough patch, it could drag down our economy and prompt central banks to lower rates to stimulate spending. And let's not forget about the butterfly effect of other economies' interest rates. A sudden hike in interest rates halfway across the globe can send shockwaves through financial markets, influencing investor behavior and ultimately impacting our own interest rates. It's like a global game of dominoes, with each move setting off a chain reaction. The Federal Reserve is the psychologist of the financial market. Now, let's delve into the fascinating world of investor psychology. The market isn't just driven by numbers, it's fueled by human emotions, from fear to greed and everything in between. Understanding these dynamics can shed light on why interest rates behave the way they do. Investor behavior can be a fickle thing. One day, they're optimistic about the economy, driving up stock prices and pushing interest rates higher. But at the slightest hint of trouble, fear can grip the market, sending investors scrambling for safety and driving down rates. It's a classic case of the fear of recession versus the reality of economic data. Sometimes, the market's pessimism outweighs the actual state of the economy, leading to fluctuations in interest rates that may seem irrational at first glance. Do you understand historical precedents of the Federal Reserve? They say history repeats itself. And when it comes to interest rates, there's a lot we can learn from the past. Join me as we journey through the annals of economic history to uncover the secrets of interest rate cycles. Past economic cycles can provide valuable insights into how interest rates behave under different circumstances. From the highs of the Roaring '20s to the lows of the Great Depression, each era has its own story to tell. By studying historical interest rates, we can gain a better understanding of current expectations and anticipate future trends. It's like having a crystal ball into the financial future, guiding our decisions and preparing us for whatever lies ahead. Now, what is the future of interest rates? So what does the future hold for interest rates? It's the million-dollar question on everyone's minds. While we can't predict the future with certainty, we can analyze current trends and speculate on what might lie ahead. Technology and innovation are reshaping the financial landscape, from algorithmic trading to digital currencies. These advancements have the potential to revolutionize how central banks conduct monetary policy and influence interest rates. Whether it's predictive analytics or blockchain technology, one thing's for sure, the future of interest rates will be shaped by the relentless march of progress. So buckle up, my friends, and get ready for a wild ride into the unknown. To prevent inflation from spiraling out of control, central banks often resort to raising interest rates, like a referee blowing the whistle to keep the game in check. But here's the catch. Raising interest rates also makes borrowing more expensive, which can put a damper on economic activity. So, what's a central banker to do? Lower interest rates to stimulate the economy, risking runaway inflation, or raise them to keep inflation in check, potentially stalling growth? It's a classic case of damned if you do, damned if you don't. But wait, there's more. In today's interconnected world, central banks must also consider the impact of their decisions on global markets. A sudden interest rate hike in one country can send shockwaves across the globe, triggering currency fluctuations, capital outflows, and market turmoil. It's like playing a game of financial Jenga, where one wrong move can bring the entire tower crashing down. So, central banks tread carefully, tiptoeing through a minefield of economic indicators and geopolitical risks. But fear not, my fellow seekers of financial wisdom, for there is a glimmer of hope on the horizon. As economies continue to recover from the lingering effects of the pandemic, central banks may gradually begin to normalize interest rates, like a ship slowly righting itself after a storm. So, there you have it, the tale of why interest rates are not dropping. It's a complex tapestry woven from the threads of economic theory, global dynamics, and human behavior. But fear not, for knowledge is power, and armed with understanding, we can navigate the choppy waters of the financial world with confidence. With that said, thanks for joining me on this journey through the intricate world of interest rates. Until next time, keep learning, keep exploring, and never stop seeking answers. Cheers.